having said what I've said, don't panic.
So Allan, G8 countries have been in a zero interest rate policy for several years, but what can we expect next from the major central banks?
Well, I think what we're going to is a negative interest rate policy environment. Just to give you a little short history about this, in fact, there's already about a quarter of the world's economy that have negative interest rates. There's 16 markets, 5 currencies. That is Denmark, the Eurozone, Switzerland, Sweden, and Japan, which all have experienced negative interest rates or currently have negative interest rates. Here on the chart you can see basically the progression of those interest rates down to the negatives, and it's really something that snuck up on everyone. You know, basically here in 2016 with the market volatility, I think there's been sort of a wake-up call to people to say, what is going on here? And this is a major event.
Absolutely. So why are banks going into negative interest rates?
Well, you know, basically, this was a mechanism that was used, tried by Switzerland in the past, in the 1970s, when they had an extremely strong Swiss franc, and it was used as a mechanism to try and devalue their currency. It's also a mechanism for the central banks to try and encourage people, rather than saving money, to actually put it to work. Because there's no benefit in basically keeping it in a bank. You're getting zero or negative interest rates. So they're trying to, let's say, encourage people to consume and spend. Also, they want to move people to taking more risk in the market rather than just saving money in a safety deposit account. They want them to actually put it to work in maybe the stock markets or in a business, take some loans, you know, basically encourage that kind of activity.
Sure. So who's most impacted by negative interest rates? Is it consumers, customers, companies, or investors?
Well, first thing I would say is anybody with money. If you have savings, you're now earning zero or less than zero in a lot of cases. But the other big factors that are at work here are for pension funds and insurance companies, because these are two major investors in the market, probably the two largest investors in the markets, and they depend on interest income to be able to pay out for insurance claims or for pensioners as they're requiring their pensions back. There has to be a return there. Otherwise, basically these entities will struggle.
Absolutely. And could there be any unintended consequences of negative interest rates?
Well, I think one of them is that it could actually have an opposite effect. Is it could let's say, make people less confident in the economy and in their government's ability to revive the economies. And as a result, it could not force people, but encourage people to take the money out and sort of put it under their mattress. So it could have actually an opposite effect. Rather than putting money to work, people sort of withdraw it from the economy. And that, along with the destabilization of pension funds, destabilization of insurance companies, and destabilization of larger banks who are deposit takers and rely on that kind of income for profits, it could have the exact opposite consequence.
Absolutely, it definitely runs the risk of injecting some fear into the markets. Mm-hmm. So what should investors do based on this negative interest rate policy? Well,
so having said what I've said, don't panic. I think it's better to be proactive, to be constructive. You know, for risk-averse clients, I would still look at quality short-term bonds. Or you know, some alternative to holding cash, such as gold. Again, that is a store of wealth. Gold has rallied in the last few months. quite substantially. It's actually had its best year in 3 decades. The gold price since the beginning of 2016 has had its best year. So there's that. There's also companies that are still growing their free cash flows. And these are more like technology companies. Here we have basically some charts since the beginning of the year of the major depository banks. And as you can see, all of them have traded down substantially, much more than the average of the market. And these are all very stable banks. So something else is going on. And basically, our thought is this is related to the negative interest rates, anticipation of it, spreading to even more markets. And these are all major depository banks. So there you can see, basically they're down, between 15 and 30%. Whereas if you look at technology companies that are free cash flow companies, so these are companies that don't have any financial stress, whether interest rates go up or down, they could care less. They're still making money and they're still growing their markets. So these are all technology companies. We've just chosen a small selection, basically some semiconductors, some software companies. Obviously, Facebook is known to a lot of people. And compared to the benchmark, it hasn't been a fantastic start to the year, but it's much better than the average. All of these companies have outperformed the average. So we think going forward in 2016, these are the kind of things that people should be looking at.
Great. Well, Allan, thank you so much once again for coming in and sharing your insights with us.
Thank you very much, Jessica.
Thank you. Well, that's all from myself and Allan, but for all the latest Dukascopy updates and exclusive interviews, do keep clicking back to Dukascopy TV. Goodbye for now.